If I were building a portfolio from scratch for 2026, I wouldn't start by asking what's exciting. I'd start by asking what's durable. Excitement fades, durability compounds. After decades in business and markets, I've learned that the biggest mistake investors make is confusing motion with progress. Buying and selling feels productive, but ownership is what creates wealth. The goal isn't to look busy. The goal is to be right over time. People love complexity because it makes them feel smart. I've watched smart people lose fortunes because they couldn't sit still. And I've watched ordinary people build extraordinary wealth by doing one thing consistently, owning the right assets and staying out of their own way. In 2026, with noise everywhere and certainty nowhere, the investors who win won't be the ones with the most ideas. They'll be the ones with the strongest structure. If someone asked me what portfolio I'd trust in an uncertain world, I wouldn't give them 20 funds, clever strategies, or constant adjustments. I'd give them 4 ETFs that cover growth, stability, income, and protection. Not because 4 is magic, but because simplicity forces discipline. When you understand exactly why you own something, you're far less likely to panic when markets test you. The first ETF I would anchor everything around is one that represents the entire U.S. equity market. Not a theme, not a sector, the whole engine. Thousands of companies across industries, sizes, and business models. This is the backbone of capitalism. It's messy, imperfect, and incredibly resilient. Some companies will fail, others will replace them. You don't need to know which ones. The market handles that automatically. This kind of ownership removes ego from the equation. You're not betting on brilliance. You're betting on productivity, on people waking up every day, building businesses, solving problems, and creating value. Over time, that has never failed. Markets crash, recover, and move on. What matters is that you stayed invested while the system kept working. I've always believed that trying to outsmart the market is overrated. Outlasting it is what matters. A total market ETF lets you participate in growth without making predictions. It lets you benefit from innovation without guessing which company will lead it. It's not exciting, and that's exactly why it belongs at the center of a serious portfolio. The second ETF I'd include focuses on global innovation, but with guardrails. Innovation is real. It drives productivity, efficiency, and long-term growth. But innovation without discipline turns into speculation. I don't invest in ideas. I invest in businesses that make money. That's an important distinction. A high-quality innovation or large-cap technology ETF gives exposure to the companies shaping the future while filtering out the ones that can't survive pressure. These are firms with scale, cash flow, pricing power, and global reach. They invest billions in research, dominate ecosystems, and adapt faster than smaller competitors. They've survived recessions, regulation, and disruption before, and they'll do it again in 2026. Technology isn't optional. It's embedded in healthcare, logistics, finance, manufacturing, and communication. Owning it responsibly isn't speculation. It's acknowledging reality. But concentration matters. You don't want your future riding on one product, one CEO, or one narrative. A diversified ETF spreads that risk while keeping you exposed to progress. The third ETF I'd include is one designed for income and stability. This is where maturity shows up in a portfolio. Growth builds wealth. Income preserves it. Investors often ignore income early, then suddenly realize too late how powerful it is. Cash flow changes behavior. It reduces stress. It reduces the need to sell at the wrong time. Dividend-focused ETFs tend to hold companies that are disciplined by necessity. You can't pay dividends consistently if your business model is reckless. These companies manage debt carefully, control costs, and think long-term. They're not chasing hype, they're running operations. That matters when markets turn emotional. In 2026, income isn't just about yield. It's about reliability. It's about knowing that regardless of headlines, something is still coming in. That stability allows you to think clearly when others panic. And clear thinking is a competitive advantage. G. The fourth ETF I'd add is one focused on protection. This is the part of the portfolio most people underestimate until it's too late. Money loses value quietly. Inflation doesn't announce itself with sirens. It just erodes purchasing power year after year. If you don't plan for that, you're slowly moving backward even when numbers look fine. An ETF tied to inflation-protected securities or real assets exists to defend, not impress. It won't make headlines. It won't double overnight, but it helps ensure that what you've built still means something in real terms. In a world of debt, currency pressure, and policy shifts, protection isn't pessimism, it's responsibility. When you put these four together, something important happens. You stop trying to predict the future and start preparing for it. You're exposed to growth, innovation, income, and protection all at once. You're not dependent on one outcome. You're resilient across many. This is where most people overcomplicate things. They ask how often to rebalance, when to rotate, when to sell. Those questions miss the point. The real work isn't managing the portfolio, it's managing yourself. The fewer decisions you force yourself to make, the fewer mistakes you'll make under pressure. I built a business by focusing on fundamentals and repeating them relentlessly. Investing works the same way. You don't need constant action. You need consistent behavior. Invest regularly, reinvest income, rebalance occasionally, ignore noise. Let compounding do what it's always done. One of the biggest lies in investing is that activity equals intelligence. It doesn't. Activity often equals anxiety. The market doesn't reward motion. It rewards patience. Every unnecessary trade is a chance to be wrong. Every emotional decision is a tax on returns. If someone was starting in 2026, I'd tell them this clearly. You don't need to know what will happen next year. You need to know how you'll behave when things don't go as planned, because they won't. Markets will drop. Headlines will scare you. Friends will tell you to do something. That's when structure saves you. A 4 ETF portfolio like this gives you a framework you can trust when your instincts betray you. It keeps you invested when fear is loud. It keeps you grounded when optimism gets reckless. That balance is what creates long-term success. I've seen people abandon great strategies because they couldn't tolerate short-term discomfort. And I've seen them chase bad ones because they wanted excitement. Neither ends well. Wealth is built quietly. It grows when you're not watching. It rewards consistency, not confidence. In 2026, the temptation to overreact will be constant. Technology will evolve. Politics will shift. Economies will cycle. None of that changes the core truth. Ownership of productive assets over time works. Everything else is distraction. If you understand why you own each ETF, you won't panic when one underperforms. You'll see the portfolio as assists. TEM, not a scoreboard. Systems survive stress. Scoreboards trigger emotion. I'd rather own a portfolio I understand deeply than one that impresses people at dinner. I'd rather earn steady returns I can rely on than chase stories I can't control. That mindset is what separates investors from gamblers. At the end of the day, investing isn't about brilliance. It's about alignment, aligning your portfolio with reality, aligning your behavior with your goals, aligning your expectations with how markets actually work. If you can do that, 4 ETFs are more than enough. They won't make you rich overnight. They'll do something better. They'll give you a structure you can live with, stay committed to, and build on for years. And that's how real wealth is built. Not with noise, not with urgency, but with ownership, discipline, and time doing the heavy lifting while you focus on living your life. Because the best portfolio is the one you don't feel the need to touch.